The stock market is an institutionalized framework formalized for a collection of international markets and exchanges, facilitating interchangeable transactions of financial securities between burgeoning corporates, institutions and private entities while equilibrating equity of information allocation and prohibition of its exploitation. Whew. Did you understand any of this jargon? Probably not, and you are not alone. Many people are not aware of what the stock market does. This is because the definitions and explanations surrounding the stock market world are still implied with very technical words, just like this one. This makes it sound like something a common person probably won't understand and will have a hard time figuring out. The Stocks Telegraph team recognized this gap of understanding. We have decided to present a simple guide on what is the stock market and how it works. Before we discuss the main topic, can we ask you a small favor? Be sure to subscribe to our channel and press the bell icon. This will help us grow. First, let's ask, what does a stock market actually do? The stock market helps you invest in companies with the possibility of increasing your net worth and profitability. And by you, we mean anyone in the public who wants to invest in a company. Companies that are seeking investments to boost their business but have been rejected by financial institutions and banks can benefit from this. In addition to this, if you invest in these companies, that turn a profit, and generate revenue, eventually, it will lead to a higher return on your investment. However, the opposite is also true. But if the company's financial performance is poor, or going into a loss for some reason, your investment will bear those losses. Having learned what a stock market is, we can now define it more accurately. A stock market is a marketplace that connects investors with companies that are seeking investments. Essentially, it facilitates the sale and purchase of shares between investors and companies. But exactly how do these two entities trade? The answer is one simple word called stocks. To better understand what a stock is, let's look at its key components and the stock market's key players. To begin with, let's look at the market's key component. On the stock market, stocks are the most important thing. The stock is an investment medium through which investors and firms execute investments. Essentially, stock represents an ownership stake in a company or a small part of a company that an investor can buy. Stocks issued by a company are bought by investors when they decide to invest in them. The key players in the stock market include investors, company stock exchange, traders, brokers, and regulators. Let's take a look at who each of these are. Who are buyers? As we discussed before, investors or buyers can be individuals like you or institutional investors who aim to invest in the company's stock. Next, we talk about sellers and companies. Sellers are companies that can be of any size and industry who are seeking investments for their business. These companies place a percentage of their business ownership as stock or equity. Units of these stocks are called shares which investors then buy. The companies gain investment in return for exchanging a portion of ownership of their stock to the investors. Now we talk about the stock exchange. A stock exchange is a place where investors and companies will trade stocks. It is a regulatory body that consists of different stakeholders. If a company meets the stock exchange eligibility and requirements, it can be listed on the stock exchange. The requirements include information about the company's financial activities, and compliance with the stock market's rules. Let's now find out who regulators are. The financial markets are governed by entities and agents known as financial regulators. These are usually government bodies, and autonomous financial institutes, that ensure everyone in the stock market is trading fairly. Regulators mainly do this by ensuring that information on companies for investment decisions is general information available for everyone in public. Traders and companies exchange information in order to prevent exploitation and illegal investments. So who are traders? Traders are investors or institutional investors whose primary job is to trade stocks. They engage in buying and selling of stock in different companies. Traders do this to profit off of short-term gains from stock price fluctuations. And finally, we ask, who are brokers? Brokers are the intermediaries between an investor and a securities exchange. These can be individuals and firms who buy and sell the stock for you in the stock exchange. Just by watching this video up till now, you know almost 70% of what a stock market consists of. Now let's figure out how all of these players and component fits together in the stock market. Watch till the end to get the full picture of the stock market. So how do stocks and stock exchanges interact in the stock market? Stock exchanges are one of the major platforms for the stock market. A company makes its stock available to the general public for investment by listing itself on the stock exchange. Once listed on the exchange, the company releases a public offering. An offering is where the company releases a portion of its total shares in the market. These shares are set at a specific price for the general public to buy. Once public investors and traders buy this offering, it is then frequently resold and bought among the public. Apart from the volume of shares released by the company, the public cannot directly buy more shares in the stock exchange. The company decides when it wishes to release another public offering. Until then, the public keeps trading the company's existing shares in the stock market back and forth. This is why the stock exchange is known as the secondary market. Let's now discuss the primary market, and how a company makes an investment before being listed on the stock exchange. This is where we dwell into what are IPOs. IPO stands for Initial Public Offerings. When a company decides to launch its stock to the public through the stock exchange or exchanges, it has to provide an initial offering of its stock to the public. Generally, this process is what is known as initial public offering. Before the IPO, a company is a private business and can seek investments mainly from certain private investors. These private investors are also known as private shareholders. Both the private investors do this transaction, hoping that the company will become more profitable once publicly launched. In the IPO, the private company finally becomes public by releasing a new issuance of stock now to the public investors. Suppose the newly public company draws the attention and has a lot of demand for its stock. Then its stock price will drive up, which reaps profit for both the public company and the initial private investors. You might ask that the stock market and stock exchange sound similar, so what is the difference between the stock market and stock exchange? Despite both being used interchangeably in the general scenario, there is a difference between the stock market and the stock exchange. The stock market consists of multiple stock exchanges and a whole lot of other key components that we have mentioned earlier. Stock exchange, on the other hand, is just a part of the stock market. When saying that one is trading in the stock market, this means that they trade in more than one stock exchange. However, when a stock exchange is mentioned for trading, it means a specific stock exchange is being chosen. There are many different types of rules and regulations governing the stock exchange. These regulations are intrinsically that of a specific exchange. At the same time, some laws govern these stock exchanges, which are enforced by financial regulators or financial regulatory bodies. All parties involved in the stock exchange are to be compliant with these regulations during any transaction. Everything that is explained until now is all you need to know about the basics of the stock market. To summarize it all up, let's explain what generally happens in the stock market with a walkthrough. A stock exchange in the stock market is where investors and traders buy stocks. This is done through a broker. A certain volume of shares is traded in that transaction between traders. When a company wants to raise revenue, it announces public offerings of its stock at a certain price. Investors buy these as well. Stock exchanges like Nasdaq, NYSE and regulators like SEC make sure that these offerings and trading are done legally. In the end, an investor owns a portion of the company's stock through their investment, while companies gain more capital and revenue. This is a simple rundown of the stock market. That's all for today's video. Hopefully, you've found everything you need about the basics of the stock market. The stock market is a vast world of concepts, and we have covered only a fraction of them. However, we will help you uncover and learn all of the concepts. This video is the first part of the educational series called Stock Market for Dummies, in which we will dive into the stock market's different fundamentals and activities. Stay tuned for upcoming videos. Making these videos takes a lot of effort and research. So by subscribing, you will help us to grow. Don't forget to leave a comment in the comment section below. We love to hear from you.